हेलो एवरीवन, आप सभी का फिर से एक बार स्वागत है मेरे यूट्यूब चैनल में जिसका नाम है कॉमर्स ट्रेजर। सो टुडे वी आर गोइंग टू डिस्कस सम इम्पॉर्टेंट MCQs ऑन accounting and auditing. Now this chapter is a very important chapter and a very lengthy chapter of NET exam and SET exams, but many of us miss this chapter because of its content. It includes your accounting part, that is financial accounting, the basic concepts and all, cost accounting, management accounting, and the recent forms of accounting. And not only that, now they have also included auditing part in this, and last year many questions were direct on this, so don't miss out this chapter and be with me for more MCQs on this chapter. So without wasting much time, let's start the MCQs. So the first question is, according to which concept fixed assets are depreciated over their useful life? Cost concept says that everything whatever you purchase should be recorded as per the cost price, whatever market price it is, it does not matters. So if you are purchasing an asset for 10,000 and the market price is 50,000, you should write 10,000 itself. This is what a cost concept says. Matching concept says that you should match your revenues and your expenditures, and by matching that you are going to get the profit. Dual aspect concept says that your assets should always be equal to the liabilities, that is the double entry system is supported by dual aspect concept of accounting. So the right answer for the concept which says that the fixed values are depreciated over a period of their useful life is your going concern concept, because it estimates that the business is going to continue for a long period of time, and because of that we have to record the assets and keep on depreciating and transfer the remaining balance to the balance sheet. The next question is, which of the following is or are the limitations of money measurement concept? Now money measurement concept says that all the transactions which are of monetary nature, that is which can be expressed in terms of money, should only be recorded in the accounting books. So if the transactions are not expressed in terms of money, they should not be recorded in the books of account. So let's see the options. The transactions are recorded at its monetary value on date of occurrence, and subsequent change in the value is ignored. So definitely this is a limitation of money measurement concept, that we record it as per today's date or today's value, but we do not consider the value which is going to happen in future, that is the changes in that particular value. Only transactions which are expressed in money are to be recorded. So this is also a limitation of money measurement concept. So the right answer is going to be both A and B. Money measurement concept biggest demerit or limitation is the important qualitative information, that is like honesty of the employee or the trustworthiness of the firm, or any big fighting between the two important parties or key positions of the company are not taken into account, but they are equally important for any company in their growth and overall performance. The next question is, as per the dual aspect concept, that is the double entry system concept, which of the following equation is correct? So the correct option is assets is equal to liabilities plus capital. So always assets are equal to liability sides, which includes capital and the other liabilities. So this is also called as the accounting equation. The next question is, contingent liability is shown due to. So as per which convention the contingent liability is shown? So usually we show all the details in our annual reports, that is the trading and profit and loss account and balance sheet, because of the convention of full disclosure. It says that everything should be disclosed in detail. Convention of conservatism says that all the anticipated losses should be taken into consideration, that is your provision for doubtful debts, your RDD, everything, all the anticipated losses are to be taken, but none of the anticipated income should be taken. So this concept or this particular thought is given by the convention of conservatism. Convention of materiality also is related to contingent liability, because materiality convention says that all the material facts should be disclosed in the books of account, that is the information which is important and material in nature to a particular business should be recorded in the books of account. So the exact answer is going to be convention of full disclosure. If this option would have not been given, we could also have written the answer as convention of materiality. So what do you think should be the right answer? Comment and let me know in the comment box. The next question is, owner is different and business is different. This is the crux of which concept? So as per which concept they are asking, both the owner and the business is different. So the right answer is business entity concept or separate entity concept, which says that owner is totally a different person, and because of this whatever he invests is treated as the capital of the business and it is a liability of the business, and whatever he draws from the business or he takes from the business is considered as drawings and it is nothing but the liability on the side of the owner. The next question is, as per which principle accounting practices and methods should remain unchanged from one accounting year to another? So usually what we do is we do not change of our accounting practices year by year. For example, in case of depreciation, so whatever method we are using for depreciation in the first year, we go on continuing the same method of depreciation. For example, if you are using straight line method, then every year you are going to use the same method, or if you are using diminishing balance method, you are going to use the same method. So this is as per which principle? As per the consistency principle, which says that your method should be consistent year by year and it should not change, it should be uniform. The next question is, all capital expenditures and receipts are to be taken to. So capital expenditures and receipts are those expenditures and receipts which are going to be received, or the benefit of which you are going to receive from a longer period of time. So if you are incurring any capital expenditure, you are going to get the benefits for a long period of time. So any such receipts or capital expenditure are to be recorded in the balance sheet. All the revenue expenditure, we record it in trading and profit and loss account. So revenue receipts and revenue expenditures are recorded in this. The next question is, which of the following is not an example of capital expenditure? So out of the four, three are example of capital expenditure. One is not an example of capital expenditure. Acquisition of fixed assets, definitely it is an capital expenditure because we can use assets for number of years. Installation and freight charges of the fixed assets also is an capital expenditure because we take the value of the asset as the value plus the freight and installation charges. Increasing the revenue earning capacity, it is also an capital expenditure because it can be used for a number of years. Repairs of the fixed asset, it is not an capital expenditure, it is an revenue expenditure because the fixed asset repair will be only, or the benefit of that can be taken only for a short period of time. The next question is, which of the following is the example of deferred revenue expenditure? Now deferred revenue expenditure is a concept which says that it is a type of expenditure whose benefit can be taken for 3 to 4 years. Revenue expenditure, the benefit expires within 1 year. Capital expenditure, it is for many years, that is 5 years and more we can say usually, and deferred revenue expenditure is for 3 to 4 years. So discount on issue of debt is an example of deferred revenue expenditure. Development expenditure, it is also an example. Expenditure on advertisement, it is also an example. So all of the above are the examples. Apart from this, any scientific expenses if you are doing, that is also called as your deferred revenue expenditure. So the last question for today's video is, cost of putting gallery in a theater hall is which type of expenditure? So if you are adding a gallery in your theater, then you are improving the size of the gallery, or you are making an improvement in your asset. So whenever you do an improvement in your asset or increase the capacity of the asset, it is treated as capital expenditure. So right option is going to be option number A, that is capital expenditure. So that's all for today. If you like the video, please hit the like button and share it with your friends. If you haven't subscribed my channel yet, please subscribe my channel and do press the bell icon so that you can get a notification as soon as I upload a new video. So thank you guys for watching the video. Meet you again with another video.